But let's dig into that for a minute. So you were working at a desk trading treasuries. So I want to talk about that for a minute because I've been talking about that quite a bit on my channel. And so obviously treasuries are a risk-free asset or whatever they call that. But lately they've been moving quite a bit. What have you been seeing in the treasury market? Let's just talk about that for a minute. Are you still
Yeah,
following that?
yes, I am. And I talk about the market with my students at USC. I teach a fixed income course over there, so we talk about interest rates all the time. And one of the questions right now is why are interest rates moving so much? And they've seemed to move quite a bit higher in the last several months.
Right.
What I always like to do is zoom out, take a moment, zoom out. Let's look at the trend. Let's look at where we are. I'm a chartist. I'm a technical analyst as well, and so I always like to look at price behavior through the lens of the chart and what are the buyers and sellers doing, and how is that reflected pictorially in an image for us. So when I show them the 40-year chart, I see a down channel in interest rates. That channel has not been broken by any stretch of the imagination. We are still in this multi-decade downward trend in interest rates. Now, on top of that, we had an extremely dramatic move lower in interest rates in February, March of last year. And through the summer as rates went to zero almost across the whole curve. So when you get a move like that and you get a 50% retracement, for example, that is in context of a normal move.
Okay.
And so right now, I would characterize the vast majority of this retracement higher in interest rates in the United States as a natural retracement of a very dramatic move last year. As last year, the market starts pricing in total calamity and economic collapse. And then we realize that people are not deathly afraid to go outside of their homes and they're still spending money. And so the economy recovers and interest rates rise back up to levels where, they were around the beginning of the pandemic. And we're not even there yet. It hasn't retraced all of that move. So, that's one side of the story, is that this could just be, things starting to get back to normal. The other side of the story is that, yes, there is more growth worldwide in the economy in the last 3 to 6 months than there was before that. And rates always price in this rate of change and momentum and how things are going at the margin. Well, right now, things at the margin are going better. So sell the risk-free asset, treasuries, that decreases the price, raises the interest rate. So treasury rates right now headed higher. If they start going above 2%, above 2.5% in the 10-year part of the curve, then we can start waving some flags and say, hey, what is happening longer term here with United States treasuries? But I think it's far too premature to make any grand conclusions about treasuries as the risk-free asset right now. I do personally anticipate treasuries to reach a yield level somewhere between here and 2%, meaning 1.5 to 2% on 10-year yields. That actually starts to slow down the economy. And how does that happen? Higher interest rates are a tighter financial condition. If you have cash in the bank and you're looking at treasuries at 0.5%, you say, I'd rather invest that money somewhere else. But if you see treasuries at 2%, you can lock that in for 10 years. Investors are going to sell their risk assets, purchase treasuries, and drive down interest rates. And higher interest rates themselves carry more interest cost for companies when they're borrowing. So higher interest rates are a natural tightening of financial conditions. They do make things a little bit more difficult. And I think we're probably at that level in interest rates sometime soon that they will start to reverse. And I do anticipate that rates will stay low for a long, long time here in the United States.